Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. There is a reason the wealth gap has been widening for decades. Billionaires are excellent at preserving and increasing their wealth. However, public SEC disclosures allow retail ordinary investors like you and me to see how billionaires build their riches. The great majority of top-tier fund managers and billionaires have been hedging their net worth against a stock market crash in the United States recently. And in today's video, we'll be talking about that. There are many investors that believe hedge funds are horrible at money management since the average fund manager underperforms the S&P 500. But more information is needed before drawing such judgment because they are solely focused on one aim, which is consistent capital growth. The majority of hedge funds are not interested in beating the S&P 500. From 1994 to 2017, this graph compares the performance of the average hedge fund with the S&P 500. You'll see that hedge funds are substantially less volatile than the S&P 500 index. During the dot-com bubble, the S&P 500 outperformed hedge funds by a huge margin. However, when the dot-com bubble burst, the S&P 500 plummeted, whereas hedge funds barely moved. During the 2008 recession, a similar thing happened. The average hedge fund lost about 22% of its value, while the S&P 500 dropped more than 50%. The reason for this is that hedge fund managers are continuously looking for ways to increase their alpha. Alpha is a statistic that tracks the risk-adjusted return of a fund. Making a lot of money during a bull market is great, but it doesn't matter if your profits are gone in a matter of months. Billionaires have recently started hedging their holdings against future market weakness. It's no secret that valuations are at all-time highs. Inflation is out of control, and the Federal Reserve is set to raise interest rates and slow quantitative easing, in which one Feds buy bonds. Interest rates are closely linked to market valuations, and a rise in rates might easily cause the market to crash. Michael Burry, Cathie Wood, Warren Buffett, Charlie Munger, Elon Musk, Bill Ackman, and Chamath Palihapitiya have all taken steps to protect themselves against a market downturn. Position sizing is the most important aspect of market hedging. Market timing is known to be extremely difficult, and you should never put a large part of your portfolio at risk of a market collapse. So instead of betting everything on short-dated options or shorting the market, set aside a small portion of your portfolio as a hedge against your long-term investments. In the case of a market meltdown, you can sell your hedged position and use the proceeds to buy stocks for long-term gains. Bill Ackman, a hedge fund manager with over $13 billion under management, has started a minor bond market short position. This position is only worth about 1 to 2% of his overall portfolio. But if bonds drop, it might become as much as 10% or even 20% of his total portfolio. Bond yields are currently around 1.8% below the rate of inflation. If inflation gets out of hand, these yields may easily rise to 4% or even 5%. Bond rates, on the other hand, will never go below zero because investors may get 0% returns on cash. This is an asymmetric risk because individuals who are shorting bonds are taking a low-risk position while also having a great potential for profit. Ackman recently argued that the Federal Reserve is understating its attraction strategy. While it has become conventional wisdom that the Federal Reserve will raise rate 3 to 4 times this year to mitigate inflation, the market expects 25 basis point increments. The unresolved elephant in the room is a loss of the Fed's perceived credibility as an inflation fighter and whether 3 to 4 would therefore be enough. The Federal Reserve could work to restore its credibility with an initial 50 basis point surprise move to shock and awe the market, which would demonstrate its resolve on inflation, he said. Bill Ackman is basically pushing the Federal Reserve to raise interest rates for the sake of the economy. Ackman is well known for his market manipulation. His hedging method is still worth noting, but you should never believe anything he says. Bond derivatives, which are comparable to options contracts but for bonds, are used by Ackman. When it comes to inflation, crypto has always been a fantastic store of value. A long-short equity strategy is another common way to hedge against overall market weakness. Top-tier hedge fund managers frequently employ the long-short strategy since it significantly reduces short-term risk. Chamath Palihapitiya, the CEO of Social Capital, and Cathie Wood, CEO of ARK Invest, are two fund managers that have just started utilizing this approach. The key to using the long-short equity strategy is to buy and sell companies in the same industry. As a result of making such a move, you would profit from the difference in the company's performance, often known as the spread. Chamath is shorting Meta, Amazon, Apple, and Netflix while going long with Microsoft and Google. This means Chamath's position will be unaffected if big tech as a whole collapses. Similarly, if big tech rises, Chamath's position will remain mutual. He is betting on whether Microsoft and Google will outperform Apple, Meta, Amazon, and Netflix, rather than betting on the sector's growth. Because valuations aren't as important, the risk is drastically reduced. Chamath's trade will be unaffected if big tech is overvalued. Only the individual company's comparable valuations matter.
Chamath, do you think that the Google long Netflix short play is the right play?
I think the best trade on the internet, the most obvious, simple money-making trade is long Microsoft, Google, short big tech, short the rest of big tech.
Short IBM, short Netflix.
No. Short. No. Meaning you can very comfortably short Apple, Facebook, Amazon, Netflix, and be long Microsoft, Google. So as a spread trade,
right.
It's the best risk parity trade on the internet right now. I mean, period, in the markets.
Chamath has been a phenomenal performer over the last decade, but this trade isn't even from him. He simply heard it from an anonymous hedge fund manager and replicated it.
When you're betting on internet stocks, you don't necessarily have to be naked long or naked short, which comes with a lot more risk than if you were long one security and short another against it. So for example, over the last 10 years, you would have made a lot of money by being long Amazon and short a basket of traditional commerce companies, offline commerce. I'm going to make up a basket, but Macy's, JCPenney, Kmart, Sears, right? So if you were short those and long Amazon, that's what's called a spread trade. You're basically playing the gap between your longs and your shorts.
It's independent of where the market generally trades. It's one of the key
irrelevant
points.
Of the market.
Right.
You're basically
because
saying
those stocks could go up, but just not anywhere near Amazon.
Yeah.
When you put that trade on, for example, it's I'm going to bet that if everything goes up, Amazon will go up more than Kmart, Walmart, Sears. And if the stock market goes down, Amazon won't go down that much, but these ones will go down a lot. And you're playing the spread.
Chamath just started another spread trade in the financial payments sector. Chamath is shorting Visa and MasterCard and seeking cryptocurrencies with robust payment infrastructure.
I think that this is the year you can put on what probably will be the most profitable spread trade of my lifetime, which is to be short these companies, and that anybody that basically lives off of this 2 or 3% tax, and be long well thought out Web3 crypto projects that are rebuilding payments infrastructure in a completely decentralized way. Now, that doesn't necessarily mean that what you say won't also happen, both that Stripe will have an incredible IPO and that a lot of these scammy crypto projects will go to zero. However, if you read the white papers of these crypto projects, and you systematically put together a framework, I think you can be long those and you can be short Visa, MasterCard, because I think this is their peak market cap.
Because Visa and MasterCard put excessive fees on customer spending, Chamath thinks this will be the most profitable spread trade ever. The typical transaction charge is between 1.5 and 3.3%. The payment system may begin to alter with the advent of decentralized cryptocurrencies with fast payments and low costs. Even if cryptocurrency isn't ready to replace all forms of payment just yet, any change must begin somewhere, and market prices are always forward-looking. However, many of these cryptocurrency ventures are aimed at developing countries that require an online payment system. Crypto will not be able to completely replace existing traditional credit card firms until it reaches scale. That is why, in order to test and develop their payment infrastructure, cryptocurrencies are targeting nations like Nigeria. Amazon has lately ceased accepting orders from the United Kingdom. Visa credit cards have been issued, which could indicate that companies are seeking new ways to accept payments.
Amazon, earlier this year, Nick, maybe you can post this, decided to just shut Visa off in the UK.
Oh yeah.
Now, Amazon is not going to do something like that, in my opinion, unless it's a test of what they can do all around the world. And again, going back to this idea of arming the rebels, There really is no need today for all of these small businesses to sit on top of Visa, MasterCard, and Amex rails. It's unnecessary. And so it'll probably get developed in the developing world first. This is why I think, focusing in markets like Nigeria, to me, are way more exciting than talking about these fading Western European countries. Who cares?
Right.
This is where this stuff will happen. It's not to say that those other companies can't, trundle along for a while. But when I say, we'll look back in 10 years and their market caps will be materially lower, anybody in those traditional infrastructure and rails versus anybody in this new infrastructure and rails it will look like a no-brainer.
You could think Chamath's spread trade is for the next 5 to 10 years, but he predicts that such a disruption will be obvious within a year.
This is not one where I think this disruption happens slow. I think it happens swiftly.
Swiftly being 5 to 10 years?
No, like in a year.
On the other hand, Cathie Wood has just begun employing a long-short equity strategy for traditional businesses that are being disrupted by innovation. Cathie's position in Tesla while shorting GM and Ford is one of the famous examples of this. Despite GM and Ford's efforts to electrify, 99% of their revenue will be lost to programmatical disappearance over time. This will theoretically help Tesla to gain market share from Ford and GM.
Well, we have internally for employees only. We're testing out a portfolio, but it's really ARC on steroids, if you can believe that. We don't think we want to test it out on ourselves first and make sure that everybody keeps their eye on that 5-year investment time horizon, which is our time horizon, and doesn't pay attention to the day-to-day, because what we would be doing is shorting stocks that are in the big benchmarks. And when we get into a risk-off situation, what happens is portfolio managers and analysts generally run back to those stocks, get closer to their benchmarks, and they dump our stocks, which are either small parts of benchmarks or not in benchmarks.
In addition to the measures I have mentioned, there was another approach to protect yourself from the recession. This technique is special in that it does not need you to short companies or asset classes. Going long on international stocks is the strategy I'm referring to. This is controversial, but many fund managers have jumped on the bandwagon and bought Chinese stocks. This is because as the value of the US dollar falls, the value of other currencies rises in comparison. If someone invests in Chinese stocks, they are effectively hedging against a drop in the US dollar value. This is due to the fact that Chinese businesses will be dealing with the revenue in yuan rather than dollars. As a result, if the US dollar falls in value, the Chinese yuan will rise in value. The world's largest hedge fund manager, Ray Dalio, is seizing the opportunity. Dalio has announced the launch of his largest China fund, which will invest solely in China in November 2021. There are other macroeconomic issues at play. Ray Dalio is dubbed as the king of alpha because he is constantly looking for strategies to reduce volatility while maintaining long-term gains. He is hedging himself and his clients against the US dollar as well as the US stock market by including China in his portfolio. Charlie Munger, Buffett's right-hand man, may share a similar perspective. Due to high valuations, Munger has predicted a lost decade for US markets. Munger has been diversifying his holdings in Alibaba stock over the last few months. Munger said that he increased his investments in Alibaba in the most recent quarter. Alibaba stock now accounts for more than a quarter of his portfolio, which is a big amount when compared to the rest of his holdings. The final approach to hedge your portfolio from the recession is to keep some cash on hand. When Elon Musk sold a portion of his Tesla stock, he most certainly had this in mind. Elon indicated shortly after selling his stock that he anticipates a recession will occur as early as spring 2022. Warren Buffett shares this approach and Berkshire Hathaway has a record cash pile of $149 billion. Then Berkshire's total market capitalization became $715 billion. This means that over 20% of Berkshire's market capitalization is held in cash, which is a significant amount. If you do decide to keep cash, it's critical to consider position sizing. While inflation eats away your money, the market may easily continue to rise, so you would only retain 15% of your portfolio in cash, especially if you're currently employed. We've discussed a variety of strategies that billionaires have used to hedge from a market crash, but the majority of these investors still have a significant amount of money invested in the market. They've simply added the holdings they need to protect their existing portfolio from the market crash. These positions are likely to have had a negative impact on the market in recent months. As GameStop has proven, retail investors do have influence in the market. However, the fund managers we discussed in this video are arguably far more influential. These are strategies we can learn and use in our own investing strategy. What do you think? Maybe share your thoughts down on the comment section below. And thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.